Bitcoin is truly unique in many ways that every kinds of investors will come to realize its unique properties.
Jeff Park begins with a critical observation. In designing money, you can't have both price stability and quantity stability at the same time. Fiat currencies prioritize price stability by allowing central banks to change the supply. But Bitcoin flips this model entirely. Its supply is fixed forever at 21 million coins. That means the pressure release valve is not quantity, it's price. And price, by definition, has to move, often violently to adjust to demand shocks. Bitcoin's volatility, therefore, is not a bug. It's a feature.
Absolutely. Most of us, I think, in the financial services industry are taught to be afraid of volatility or to think of it as something to be less desirable. But the reality is volatility, if harvested correctly, can actually be a very useful tooling for not just risk management, but also for yield generation. And at the core, Bitcoin's volatility is very much a feature. And it is really designed within its monetary construct as to the fact that there are really two trade-offs you can make in the design of money, which is that if you want price stability, you have to have quantity stability as the thing that you might have to trade away, which is the basic foundation of our monetary policy with fiat. But the flip side of this is actually if you fix the quantity, well, then by definition, the price has to be the outlet in which there is going to be volatility. And that is, in fact, a healthy thing. That is the natural design of what money can be. And so I think Bitcoin, it's garnered a lot of attention, mostly because of the volatility. In a way, that in itself is a bit of an attention economy in itself. And the reality is a lot of young people do gravitate towards volatility as a source of alpha, as a source of generating wealth that is not exclusive to just Bitcoin, in my opinion. It's actually fairly present in the retail investing world broadly, within the way that people want to express views on small market cap exposures, or event-driven risks that are coming into play by activism and whatnot. So I think the unique opportunity here is as institutionalization has taken Bitcoin to higher thresholds of ownership, what is the level of volatility that we can expect going forward? And there, I would say volatility is a nuanced definition and metric in itself. Most people think of volatility as the standard deviation in percentage terms of an asset's price, and that can be measured monthly, quarterly, yearly, etc. But it's a close-to-close observation. What it means is that it doesn't actually accurately capture intraday dispersion. So if a stock went up a bunch and then came down at 4 p.m. the same day, it would look like it's a zero vol asset. But we all know that was not a zero vol day. And intraday volatility in crypto is just as important as close-to-close volatility. So that's the first point I would mention about what's really unique about Bitcoin. And then the second thing is there's second and third orders of magnitudes with volatility measurement too. So for example, volatility exists in a range of distribution, but just because it steadily exists in that range of distribution in a normal and predictable way, doesn't mean it's not a volatile asset either, meaning the jump risks on the left and right tails also quite matter. So if something is steady for, let's say, a month where the volatility is 30, and then one day it has a 200 vol day, some might still say that average blended volatility is not very high, but you and I as humans know that was a volatile stock or a volatile asset or a volatile day. And the beautiful thing about Bitcoin is it actually exhibits a lot of fat kurtosis. There are days when Bitcoin gaps. This is when people get really excited and the volatility and spot relationship often changes during these moments of asymmetric performance. Today is actually a great example. Today's a great example that when Powell came out with his announcements on how he's redesigning and rethinking about the monetary framework for monetary policies, Bitcoin gapped. It was a big move. And when you look at kind of traditional market structure, you have huge trading volume at 9:30 to 10:30, and then you have huge trading volume between 3 and 4 p.m. That's generally when the activities take place. So it does make sense people look at close to close for monitoring and modeling what they think are important attributes of volatility for stocks in this fashion, because that's actually what the volume is. Crypto is a little different, or at least it had been very different until institutional adoption of the ETFs, which is that volume can be dispersed. It can happen during US hours. It often also happens during Asian hours in meaningful ways. And that means 4 p.m. EST to 4 p.m. EST might not actually be when the volume happened for the observations you want to monitor. So a lot of times what you do see is quant strategies trying to model volatility using different time horizons where they believe the alpha actually sits where the volume is most proprietarily acute. And that's why I think even when you look at realized vol measures from Bloomberg versus Deribit versus Coinbase, they all spew different numbers, actually. You're precisely right that there's no standard metric here, but I think that's also why there's a lot of alpha. And the other point I would mention is more important than close to close volatility, in my opinion, is even if you want to use like a 24-hour window, the better version is actually knowing the spread between the highs and the lows of that day. We call this Parkinson volatility, but essentially that gives you the full range of actually the day's motion of the asset rather than just one point in time in that 24-hour observation window. Absolutely. So an example I would share with you, even when I was at Morgan Stanley, we would have structured products issuances that were very much dominant with Asian clients. So a very popular trade back then, and still today, is you can make a pretty decent premium and spread by selling vol in Asia and selling vol in the US and buying vol in Asia, because there was always a structural bid for protection with the US stock market. And Asians generally enjoyed selling vol in their own markets. So whatever indices were popular, the Nikkei and everything else, you could actually see that most people were selling vol in the derivatives market. And so paying attention to those flows, which tends to actually be structural because of the wealth management business, gave you a tremendous insight into where the vol relationship would morph over time. You could actually do the exact same thing in crypto. It's just different. There isn't, of course, structured products yet, but actually it highlights the real important role of derivatives, because what you actually can do in crypto that you can't do in traditional equities market is have full transparency to where positioning is sized in the derivatives world, which is why a lot of times you see on crypto Twitter so much focus on different liquidation levels and different open interests. And these are perps and options where, because these can be liquidity black holes, people are very mindful of when those targets are nearing. And sometimes it does become a little bit of a self-fulfilling prophecy, if you will, in terms of how the gravity of the attention to those metrics will pull people into certain trades. But it just so to highlight that derivatives are really important because they're actually just capital efficient ways to express more price exposure in a way that is actually why Bitcoin investors exist. And it's actually also why Bitcoin treasury companies have caught such an interest for investors, because if you really squint hard enough, what Bitcoin treasury companies are doing is essentially harvesting a more capital efficient way to find exposure to Bitcoin.
In some cases, Jeff compares this to credit cards like the Gemini card, which reward users in Bitcoin. Unlike traditional cards that reward points in dollars, these cards offer rewards in an appreciating asset. If Bitcoin doubles, a 3% cashback reward turns into 6%, then 10%, then 20% over time. It's not just rewards, it's long-term Bitcoin-denominated returns. This illustrates how financial institutions can build products around Bitcoin that normalize a Bitcoin standard mindset, where people think in terms of accumulating sats instead of just spending dollars.
This is a pretty standard normal trend, unless it's biotech companies, in which case people are speculating on phase trials and they may want to actually have more open interest to the upside. But all things considered, puts are more expensive than calls. Bitcoin is not that. Even today, even though vol is low and realized been low, even today, open interest for calls are much higher than puts. So actually understanding some of that path dependency is really, really important, because what ends up happening is when there is an accelerating and asymmetric price performance on Bitcoin to the upside, what you will see is the implied vol will also go up. And that relationship is the most perhaps sacred relationship of Bitcoin, as I think of as a financial engineer, and the value to appreciate. Today, even as Bitcoin went up to 116K, vol actually did drop. So implied vol went from 37 to about 32. And that shows you that maybe there isn't as much belief in the momentum behind the move that we saw today. But over time, what you see is if there's higher conviction, higher volumes, and the market depth of the order book starts shrinking, where there's actually less liquidity to the upside, you will see that vol picks up with the price. And that positive correlation, very hard to see in stock, frequent in Bitcoin. And
why do you think it's frequent in Bitcoin but not in stocks?
Because stocks are at some level, I would say, without being too overt, manipulated in the way that there's always structural bids and sellers for different reasons. And so if a stock goes up really high, what you might see is a company will come out and actually just issue more shares, right? If they believe it's overpriced and they think that's an opportunity to take lower return of capital to actually invest in something else. And so they can affect it. They can affect the issuance. Of course, you can't do that in Bitcoin, right? The whole point of Bitcoin is that it's fixed supply and that actually the supply cannot be manipulated. Investor's dream, in my opinion, it's a retail investor's dream because the kinds of information that is available in a democratized way for everyday user like yourself and I is actually the edge. When you think about the commodities market, it's fragmented. The volume is often hidden between market makers, and the producers play a really big role, of course. And so you can't often get like a very clean picture of that supply chain, which is why there is so much outperformance and alpha to be had if you're an excellent commodities trader. But in Bitcoin and crypto at large, all of this is fairly public. So my very good friend at FalconX, David Lawan, he publishes the depths of market with kind of 5% moves and 10% moves and where the bid offers sit. And he aggregates all these informations just using what is publicly available. And that in itself is actually a really powerful signal to anticipate breakouts. Because if you see liquidity decreasing on the ask side and you're actually seeing the buildup on the bid side, you can start to get a sense for, oh yeah, there's actually momentum here. There might be a little bit of a supply shock. Mostly accessed crypto products through regulated securities and commodities futures. So the ETFs play a big role, of course, and then the CME futures contracts play a big role, of which most of the derivative trading volume, I would argue, still happens offshore. And so when you look at the CME, for example, Bitcoin is truly unique in many ways that every kinds of investors will come to realize its unique properties, mostly because there are certain trade-offs made within financial securities for which it's impossible to have all of these features that Bitcoin only has all. So when I think about it, people forget, I mean, these mega trillion-dollar companies have tons of cash on their balance sheet, tons of cash. And that cash—
You mean the 36% year-over-year growth of Facebook's like net income is generating real cash?
It's a real business. I mean, we just don't call them banks, but they have tons of cash. Fundamental core belief here is that if you believe your crypto asset is valuable, then that is an optionality that is not just fighting fiat debasement, but there's upside capture that is actually possible as well. I might also add Ripple into that example, where the ability for Ripple to have potentially had acquired Circle, as you know, Circle of course IPO'd, but there was conversation Ripple would be in the bid for it, is a pretty transformational thing. Imagine in an alternate parallel universe that Ripple actually did buy Circle, the largest stablecoin issuer here in the United States. That's what a crypto treasury company can do as long as the asset is pristine and valuable. And the intuitive example that just retail customers might appreciate is that Gemini's credit card in itself is actually a Bitcoin native financial institution service offering, because when you buy with Gemini's credit card and you're rewarded in Bitcoin as a percentage of your cash outlay, your spending outlay, you're essentially measuring the points or the value transfer that you otherwise might think of in percentage terms of dollars into Bitcoin. So when people buy Chase Sapphire cards to spend on dining and travel because it pays more than actually just buying regular goods, and it's 3% versus 1%, they play this game, right? Why do they play this game? Because they're trying to outperform something. They're trying to outperform their spending for some better offer than other credit cards based in dollars. If you're thinking about the Gemini card, yes, you're thinking about that a little bit, but what are you really betting on? You're betting on the fact that Bitcoin's going to basically double. And so whatever you thought was 3% is actually 6%, and maybe it's actually 10% and 20% years down the line. That's a Bitcoin denominated return. That's a Bitcoin denominated mindset. And I think more financial institutions can think about these as ways to lure consumers and customers to normalize that as a way of thinking.
Traditional finance was built to suppress volatility. Central banks smooth cycles, companies issue shares, and governments intervene. Bitcoin does the opposite. It embraces volatility as the honest reflection of free market price discovery. For traders, that means endless opportunities. For institutions, it means new hedging and yield strategies. For retail, it means transparency and a level playing field rarely seen in other asset classes.